Good afternoon. I welcome you to today's hot topic webinar here together with Admirals. It's Wednesday. It's the 15th of December. Of December 2021. And today we wanna have a look at an interesting topic right now. Probably you have wondered how to how to trade certain indices as of now. And today we want to focus on US equities, and especially here the US index, the S&P 500. And I want to present you a strategy which is proven profitable. In fact, is a strategy which worked out quite nicely, not just over the last decade. So I'll give you a backtest result here from the last 10 years, since 2010, more than that. And not just that, but also I'll give you some insights into the performance of the last 2 years, in fact, and the real life performance in this context. Has been a difficult environment for the basic strategy, but still the strategy proved out to be profitable and worked quite nicely with a positive expectancy here. And in addition to that, I'll also give you some ideas on how to improve the overall profitability, not just from a discretionary perspective when it comes to Dow theory here, price action trading, but also in addition to that, I'll give you some insights you probably can use then, not just for trading the S&P in the future, but also on other indices like the DAX, for example, but also FX pairs, where something I refer to as Asia breakout comes into play, and where we can use volume ideas here to increase the likelihood of a breakout, in this case, working out nicely for us. If you watch this now on YouTube, please subscribe to the YouTube channels. Set reminders so that you get a notification once we send a new video to the YouTube channel. It's not just me, but also Paul and Marcus. We prepare videos for you here in the trading community so that you can hopefully profit from them and can learn something from it. So leave a comment if you enjoyed what you're seeing. Leave a thumb up here. We'd really appreciate this. And yeah, that's it around the introduction. So jump right into the action. So this is here, the first slide. It's the question on how experienced traders right now trade the S&P 500. Before we start, first of all, let's have a look here at Admirals first. Broker you probably have heard about before. It's Admiral Markets, and there was a rebranding taking place over the last months, and Admiral Markets is now Admirals, and the reason for that is quite simple. So Admiral Markets started out in already 20 years ago, something like 2001, if I'm not mistaken, as a CFD and FX broker, and has, as of now, 8,000 and more financial instruments available, being tradable as an FX currency pair, respectively CFD, and has global presence around the globe. So it's fully regulated and licensed by the SISEC, FCA, ASIC in Australia, also by Jordan regulatory body here, and especially here over here in Germany. So I'm located in Berlin in Germany. We refer to Admirals as the so-called DAX expert, in fact, with a very, very competitive, probably the most competitive offering when it comes to DAX CFD trading. But it's not just the DAX, but also the FX offering, which is really very nice. And you should have a deeper look at the website, admirals.com here. And now coming to Admirals, respectively Admiral Markets, just to give you an idea on the rebranding. So it's not just that it's a classic broker, multi-asset brokerage right now, not just offering FX and CFD, but also physical stocks, invest solutions, and all so on and so forth. But also there's now the next step being taken to become a global financial service provider with, for example, offering a credit card. You can transfer your trading, hopefully gains, to, and then go shopping over at Amazon or something like that. So and there's further steps being planned also for the future when it comes to crypto in this context. And make long thing short, if you are looking for a good broker, then probably Admirals is for you, and you should visit the website admirals.com for further information. As I already pointed out, one world, one broker. So global presence, which is very important. So I started out, in fact, as a clerk with a bank, and I had an international audience. And what I know is that people are usually very sensitive, let's say, or yeah, probably the right way to put it, when it comes to speaking their native language, when it comes to financial questions. And that being said, increases the chances that you reach out to someone in service, respectively support here, who's speaking your language. I mean, English is not a big issue, but probably your native from another country here, speaking initially another language. And this is definitely something to consider when looking for a broker. So admirals.com for further information. Let's jump into today's agenda and have a look here at what we want to focus on today. So first of all, what we want to do is we want to define the so-called open range breakout setup for the S&P 500. We went through a similar setup, in fact, when it came to the DAX. And the thing is that it's usable, or you can trade this setup, in fact, in different markets. It's not just the S&P, respectively the DAX, but also in addition to that, there's a possibility to trade this when it comes to FX markets, for example. So I already referred to this as Asia breakout, similar approach. The thing is open range. Usually this refers to you have a clearly defined time window here, which is around the market opening. When it comes to FX, obviously, it's difficult to spot an opening range, because you have a 24/5 market in this case, and there's no interruption taking place, or at least not during the week. So the weekend, the markets are closed, and then we take it from there, right from I think 11 p.m. German time. It's German in the UK, I'm not sure. In the evening before or Sunday evening, and then taking it from there with the first quotes from Auckland. But you can use these ideas here I present to you, also duplicate this to the FX world. Certainly, the approach needs adaptations, but in case of the S&P 500, I can give you these adaptations already, or the parameters. This is what I prepared, what I have prepared for you. I'll show you the setup in the real world. You can, in fact, start out trading it already today, even though there's one certainly interesting aspect to note here. We have the FAT in the evening. So chances are high that the volatility will be subdued around market opening, even though recent days we have seen some heavier moves on the up and on the downside. But the thing is that breakout approaches in general should see an elevated level, not just in terms of volume in general, because especially the so-called R vol is high, so the relative volume compared to the days before is higher than usual. You can see that the breakout is likely to be successful. In addition to that, you also need a certain level of volatility. And again, these parameters will be produced, or will be provided from my end within the next minutes. Then, in addition to that, the question certainly arises, okay, is this a profitable setup, in fact? And it is. I can already tell you that. I'll give you some backside data and also a small anecdote how this screenshot happened. And then in addition to that, I'll give you also some real world data here, how the strategy performed over the last 2 years in this case. And then at the end, it's not just the basic idea and the key parameters we'll go through, but also I give you some ideas on how to smoothen the equity curve, and give you, even though you can easily program this and let the strategy run via a so-called virtual private server, respectively VPS, you can also here optimize the strategy and give it, let's call it a discretionary touch, and optimize based on your price action reading skills and charting analysis. I'm here how to optimize it. I will show you some ideas here, and then in addition to that, also on top of that, I'll also give you some further ideas on how to profit from this in your trading and how to bring your trading to the next level. So it's not just that you take the parameters and then take it from there and fully automate the strategy, let it run, and then just sit back and just enjoy seeing your account growing, but you also want to grow as a trader. And I'll give you some ideas how to achieve exactly that here with this approach and the parameters. So we'll start right away with the key parameters here. If you want to take a screenshot, you can certainly do that. There's no secret, or this is not the holy grail, but it works. That's definitely something I can assure you. What we'll do is, and that was already something I referred to at the beginning when talking about the opening range and then trading hours, so especially spot trading hours. We want to see elevated volume in this case, and this is why we are focusing here on trading the breakout once the Wall Street is open, once there is a true volume coming into the market. And what we do is then we look at the first 45 minutes of trading. So around this time, you see some elevated volume in the market pushing up on the downside, on the upside, on the downside, and building out a trading range. And the first 45 minutes of trading help you to define here, in fact, the high and the low. And then what you do is very simple. You identify an advantage. This is something which we usually should do all the time when trading the markets. So trading in direction of the overall trend, respectively, at least of the short-term momentum here. And we'll use here the EMA 15, the EMA 10 on a 15-minute time frame, that way around. So we look at a 5-minute time frame when it comes to the DAX. In case of the S&P, we look at it a 50-minute time frame. So you probably have seen one with a webinar within our hot webinar topic series here with Admirals. And when we worked with the DAX, we had a similar approach, but we had a different time span we looked at. In case of the DAX, it was 8 a.m. till 9:05 a.m. German time, so CET in this case. In case of the S&P, it's 3:30 to 4:15 p.m. And in case of the DAX, we looked at a 5-minute time frame in the EMA 50. So this was our, let's say, advantage identifier, if you want. And in case of the S&P 500 here, we look at the 50-minute time span, and then we look at the EMA 10. And what we simply do is we say, well, if we trade above the EMA 10, then we take only breaks on the upside and enter long trades here. While if we trade below, or the last closing price of the 15-minute S&P 500 here is below the EMA 10, then we only trade on the short side and only take short positions here. And what we simply do is we trade the break then out of this range on the given side where the advantage is given. And the stop, we place it at the top or at the low of the range, depending on whether we are taking the long side or the short side. And now the interesting thing is, in case of the DAX, we worked with an approach where we said we will have a predefined risk-reward ratio here of 2 to 1. In case of the S&P, we're just keeping the trade till markets closed. And in this case, it's a purely intraday setup, which means it's day trading setup, which means that we take out the trade shortly before Wall Street closes, which is 10 p.m. German time in this case. So it's 9:50 CET when we take out the trade. We don't want to probably jump here into the last minutes of trading. I'm taking 9:50 here because sometimes you probably have seen that the markets start to close on holidays once there's some kind of, I don't know, Thanksgiving or Xmas or something like that. So usually I try to avoid trading during these conditions, but sometimes I still have a position on, and then I try to not to keep the position till the last moment, even though, and this is something noteworthy, there has been a time once you see or once you saw a so-called ramp into the close. This is something which is very interesting sometimes, where you can sometimes see that the market is taking on bullish momentum because there's some kind of chasing into the close, especially if the market was very strong, or sometimes because the financial media wants to give market participants some kind of a positive picture. It's not the media guys buying the S&P then, but it's more like portfolio managers, for example, trying to initiate some optimism that there was buying taking place, or the day has not been that negative as it might have been before the last or over the trading day in general. So to some extent, sometimes you have the impression that there's some kind of manipulation taking place. If you're on long side, you can profit from that by profiting from such a ramp into the close. If you're short, then you probably will really take out the trade a little earlier to not being a victim, let's say, of such a ramp and giving back some of your hard-earned profits in this case, or floating gains, but still. And these are the parameters for the trade. So the thing is, now there's lots of theory behind this. Let's have a look here at the chart and give a better idea. You can already see here, this is a slide I took from the last presentation on the DAX, combining human pattern recognition with the use of technology in this case. So what we in fact do is we recognize a pattern where we say, okay, well, once we break out of this range, it's likely that the market continues to move into that direction, and we try to automate this process. So even if we take the trade manually, still we have a clear predefined rule set we follow, and we go through step by step. So this is to some extent already technology-based, respectively, at least semi-automation of your overall trading, even though all these parameters I presented in the slide earlier could easily be automated, and then you just let an expert advisor here run through your MT4, MT5. And so what we have here is the S&P 500 CFD, in this case, 15-minute time frame. And you can see here, this is the high and the low within the first 45 minutes of trading. And as you can see here, this is the purple line, this is the EMA 10. And what we have is here this open range, as I defined it earlier. The first 45 minutes after Wall Street open, from 3:30 till 4:15 p.m. Central European time. And so then, well, you may have already guessed, if these are the first 45 minutes of trading here, and this big green candle, so you can see that there's a close above here, even though it's a close which is slightly above, but still above. And this is where the automation comes into place. And sometimes market participants might probably say, well, I'm not really sure if I want to take this position here because this doesn't look that promising. On the other hand, the automation of the process and taking out most of the emotions here is resulting that you're entering the trade here on this breakout above. And the stop is placed here at the bottom of the range. And as you can see, there's no turnaround here. So the market continues after its breakout to trade higher and to trend higher, and you keep the position till the market closes. And this is in fact here. Once we start to stall out, let's say, into the close, so there's no further momentum. The momentum then is taken on again overnight, but we have a pure intraday pattern in this case, so or pure intraday position, so we don't want to take a position overnight, and that's in fact it. So nothing more to say here. Now you might wonder, well, is this really profitable? Can this work in the long run? It's surprising that the easy approaches here really work out really nicely. And here is the recognized pattern, which we let's go through then over a period. And this in fact is I'm showing why sometimes it could make sense then to have here an expert advisor running through the data here and showing how the strategy performed then in the past, because it makes things easier and shortens things up. And what we have here is a time span, November 2010 till July 2017, and the chart now might surprise you because this is like in Excel, and there's a story behind this. So let me just show you this story. So I was holding a webinar together with another trader, and this guy was or is very quantitative quant, yeah, so a fully automated trader in fact. And so what he did was that he said, well, I take the parameters and I program this in Excel, and I'll run this here, and then this is something we will provide to the audience then, and show them that the strategy really worked. And so the problem was that day when we held the webinar that there was an internet connection issue at his end. And so when he went through the presentation, respectively when he opened here his Excel file to guide the people through how he programmed this and all and so on and so forth. There was already some interruptions when he was talking, and so what I did was I just took a screenshot, and this is one of the reasons why you can see it here. So there's this is not a clean screenshot, let's say. I took the screenshot just to be prepared in kind of he gets interrupted and his internet connection is lost. And this is exactly what happened 30 seconds or something like that later. And I take the screenshot from there because it perfectly illustrates over and over again, because first of all, it's a nice anecdote, and second, it perfectly illustrates some key parameters, and it shows perfectly how well the strategy performed under certain or several market conditions here. So it's not just that we look at a very favorable environment, let's say, and that it worked once, let's say one summer or so, and then I show you the backtest here, but this is really a time span over 7 years, which had different market environment. So there was a higher volatility environment. This is especially the Greek European financial crisis in, I think it was somewhere 2010, yes, but also 2011, if I'm not mistaken. There was very high volatility in August 2011, if you remember. That was the downgrade of the US rating from, I think, S&P, if I'm not mistaken, caused some heavier volatility, in addition to all the turbulences we saw around the European debt crisis and Greece. We had a very low volatile market environment. A low volatile market environment means the time, especially between 2014, 2015, well, probably that was the time when volatility started to pick up again. But 2014 was very low volatile market environment. Then we had a political environment. We had some heavier swings here in August, September 2016. Probably some of you remember that was shortly before Donald Trump was elected the 45th president of the United States. Comments before, and there was some speculation around some emails from back then Hillary Clinton and whatever, and so there was several market environments which are covered here. But all in all, you can see that this is a rising equity curve from the lower left to the upper right. And what's even more interesting here is in this context that we can see the win rate, respectively the average profit and the average loss, which obviously is a positive expectancy, and showing that there's a positive expectancy in this context. And it's showing you that the hit rate, even though it's below 47%, that here with this approach, as you can see, the average profit, let me just probably do it that way. So you have, so the hit rate, 47%, and this is a number we want to remember when looking at the forward test in the next slide. Oh, I'm sorry. Average gain, it's 108. Average loss, it's 8.2. And so to get the so-called payoff ratio, what you do is you divide the average gain through the average loss. And then you get 108 divided by 8.2. And then let me just calculate this here. So 108.82. You get this is just 1.31. And you will see why I'm laughing. You will see this because it seems as if this is not just a number we have seen here through the time of the back test. And by the way, let me just before I continue, I have to write down some information here on my stock I watched today. So it's very thin given the fat, but I'm still having a look here at Lucid. You probably know this company. It's in the electric vehicle sector, and it's not that there's many stocks which are hot today, but this is probably one which is worth a deeper look. And coming back here, so 1.31 So you can see, let me put it that way. It's November 10 till July 17. So it's 7 years, different market environments. And what will be interesting is that we will see that this is exactly the payoff ratio we are getting for the forward test too. So it seems as if this is at least in the last decade, what you can expect to gain on average in comparison to what you can expect to lose, and that means that we can even here, if we have a hit rate of slightly below 50%, still be profitable in the long run. So make long thing short, the backtesting obviously already showed you that this is a profitable approach for the last 7 years, but probably we do not know whether it will perform well even in the future. And this is where we have to start to take risk here. And this is exactly what we did here for the time span between 2019 till October 21. So I stopped here. This back test when I prepared the presentation hasn't slightly changed. So you can see it's another 2 years we are looking at here. And we see a number of trades, and this is real trades. So trades which were done on the real market conditions. And you have 469 trades during this time span with a hit rate of slightly below 47%. One main reason for that is that the market environment probably changed a little. So you probably, or in general, you see that there is some trouble for breakout approaches. Sometimes volatility is increasing. Sometimes you can see that there's still some choppiness around this. So there's the spike out on the downside, and then the market takes up. This is not resulting in overall negative expectancy for the strategy, but still something to take into account, especially once you see and decrease in volume, respectively, when it comes to volatility in general. That this is probably a sign that things are not working as you expect it to perform, and then where your overall let's call it discretionary touch then comes into play. And still the payoff ratio during that time span is 1.3 to 1. So we continue to perform really well here under these circumstances. There's still some possibilities certainly to probably increase here the payoff ratio by letting winning trades continue to let them run respectively, probably sometimes cut winning trades short once you see there's, for example, a higher tendency that there will be a fake out on the downside, probably reduce the risk once we do not take the breakout as it should happen, or as we want to see it. So with a dynamic break on the upside. What's also interesting is, this is also interesting from a side note perspective. Here we have the consecutive win, respectively consecutive loss with 8 and 9 here in this case, especially the latter point here, consecutive losses of 9 in a row is noteworthy, because if you trade this for on an intraday perspective, and you trade this over and over and over again every day, and you have 9 consecutive losses, that means nothing more than you start, let's say, on a Monday, and you continue to perform or to see losing trades happening from Monday till Friday, and the next week from Monday till Thursday. This is very, very hard. And you can't really do something about it. So it's like you have to continue to trade. Sometimes there is ways to adapt to the market environment, which is probably not that favorable. And you probably will say, well, probably today I reduced the position size, but you have to continue to trade. And so the thing is why this is especially noteworthy. I traded this approach during a live trading session, and that was in fact, that was kind of a project for 3 months. And here I was trading the US market opening, and it was every Thursday. And I did this around US market opening. When I said, well, it's a profitable approach, let's take it from here. Trade the approach. And then it was at the beginning, everyone was really excited, and it was like, yes, great, there's live trading, let's take it from there. This is awesome. And then the first Thursday, losing trade. So you have 200 participants in the first event, losing trade. Okay, well, this is not very great. Next time, it's only 150 participants, because the first 50 just said, well, what is this kind of trader? I mean, he's losing money. So usually a trader, professional trader, has to make money every day. yes, I know what you want to say, but still, this is probably not really what profitability or long-term profitability in trading is about. There is losing streaks. This is something which naturally happens. So second event, Thursday, losing trade again. Next week, you had a drop rate of already 50%. The funny thing about this was that I started out 2 weeks earlier, and we are ahead because you're trading this over and over again only on Thursdays. So far, it didn't perform that well, the strategy. We had a next losing trade, and we dropped another 50 to then 50 participants. And at the end, we finished this season in the green, so we made money, and I had as you will see here in the next slide, I'll show you how to connect the account. We had it connected to an external website which tracked the overall performance, and it was something we could really rely on, and I could present to the audience. But still, from the initial 200 participants, only 50 remained till the end because they were witnessing 3 losing trades in a row. It wasn't 3 losing trades in a row, but 3 losing trades given every Thursday and the performance we've seen there. So long thing short, it's something which happens, especially with such an, let's call it easy approach and breakout approach, and something not to worry about. So you have to still manage it accordingly. So if you see that something's not working, you have to wonder why it's not working. And this is where the work comes into play, and where your discretionary touch comes into play, how to optimize the approach, but also in addition, how to adapt your risk and money management, your overall trading size in general, once it works or not. Once you drop a certain amount, let's say you're down 10%, 10 losing trades in a row, every time you lose 1%, you're down 9-10%. That being said, well, if you're down 10%, this is telling you something's not working. So if something's not working, you have to change, you have to adapt. And then it happens, but still, where the professionalism comes into play, this is exactly where you find solutions then. And what's important to tell the people, also to discuss it with the people, to show them it's not just about trading, enter the trades. This is easy, like you buy or you sell, depending on whatever your system tells you, but what you make out of the results you get. This is where trading, where true trading comes into play then, and how to work with this. So long thing short, why is this important to see that you're also consecutive losses? Because it helps you to avoid strategy jumping. Let's say you're trading this approach now and you see 5 losing trades in a row. How many times have you faced 5 losing trades and said, well, this is obviously not working? Well, I know what you want to say. Right now, it's not working, but it doesn't necessarily mean that the strategy is not working or not profitable anymore. It just could be that you're in a bad environment for the overall strategy. And this is where your work comes into play and where you have to adapt, respectively find a solution for. But from a purely mathematical standpoint, it could be that even 5 losses is not enough, but here you could also face 9, 10, 11, 12. And this is, by the way, then something where so-called Monte Carlo simulations come into play, and where you use mathematical, respectively statistical approaches then to see, for example, in so-called Bernoulli distributions here, how many losing trades could occur. But this is something which we'll probably cover in another webinar. So long thing short, this is a very important number because it helps you to keep to stay calm and to keep your cool and to stay mentally stable in this context here. Even if you're losing 9 trades, this is perfectly illustrating why you can't go all in on a trade. It's sad that the strategy is profitable, but this doesn't necessarily mean that's profitable or makes you money within the next 10 trades. Could easily be that you're a loser in the first 5-10 trades and then turn the sinking ship around. Let's put it that way. So let's come back to here today's presentation on now the question, how to smoothen the equity curve and what you could do. So first of all, this is an approach. I will give you some pictures later, but first of all, we already found an approach, but a very simple one, by saying, well, if we trade above a moving average or below, then I'm going long or short. Or see the advantage switching for the day. You can also do something a little broader, let's say, and since we're trading, it's not a 5-minute time frame, by the way. I'm sorry, it's a 50-minute time frame. What I tend to do is I want to get a broader picture. It's like I'm trading the 50-minute chart here in this context, but what is the overall market doing? So do we see kind of a, let's say, range bound environment or falling highs, but still I want to trade the long side? Or are we seeing higher highs in this context, and then for today we see the advantage switching to the short side, and there's a short signal generated? The question you always face is, am I trading with the overall, with the dominating time frame, my time frame, dominating time frame? And so if we trade the 50-minute time frame, we can say that our dominating time frame is the hourly chart. And what we then do is, what we want to find out is whether we're trading in a so-called accumulation or in a distribution area. And in case of an accumulation area, once you spot that we're trading in the dominating time span, well, then what we want to do is we want to trade more aggressively in direction of the overall trend. Once we generate a signal in direction of this dominating time frame or trend we spot in the dominating time frame. And if we're trading in the so-called distribution area, then if we trade at all, this is also a way we can do this. Sometimes I mean, this is a fully discretionary approach. I'm sorry, fully automated approach. But discretionary wise, sometimes I just say, well, I skip today. It's just not looking good, or the overall environment is just not fitting my personal style. It's like I'm not in my zone, or I'm just not feeling comfortable. So even though you try to get emotions out of your trading here with automating the strategy, which is great, still sometimes gut feeling is something you should listen to. And it's something I do sometimes. So for example, today, I just don't like to trade the S&P today. I know that we have an overall difficult environment in general, especially with the Fed on tap in the evening. And while we might say, well, with inflation picking up and right now, well, probably this is weighing heavier on the overall growth outlook, and given the big run these big tech names and given the market cap have seen, and now seeing a drop, and especially the broader picture, and then looking at the Nasdaq, for example, well, probably we see kind of a drop. Still, the thing is that today in the evening there could be a big surprise, and the Fed could come out and just tell the market participants, well, guys, you know what, we don't reduce our monetary support as much as you expected us to taper. I mean, yeah, inflation's picking up, but let's face it. I mean, we could easily dampen or reduce our asset purchases. What we will do, QE or taper in this context, we'll give you some rate hikes in 2022, but it will be maximum 3. And given that, I mean, even here, we're not really sure if we can follow that, because, well, inflation is not just picking up because we are pumping equity or liquidity into the market, but also because we have supply chain issues. So that being said, and then we make a long thing short, it could result in a sharp rally we get to see, even though the overall advantage right in the first half of the trading day might be on the short side. And since I'm not really sure what to make out of this, sometimes I have a clear bias and I say, okay, I go for this because I'm convinced that this could play out, and then let's take it from here, and I'm willing to take the risk. But sometimes it's not that clear as today, and then I just say, well, you know what, I skipped the trade. I just don't feel comfortable doing this. So that's what I mean if I say, if I trade at all, in case of a distribution area, coming back to this point here, what we will do is we will trade more conservatively. In case of a long trade, for example, which is generated, and we are trading in a very extended mode on the upside, I don't want to trade as aggressively as I would as if I was trading in the accumulation area. And here now, this picture comes into play. So yeah, broke it down, let's say. I broke it down here to this distribution and accumulation area idea. So let's take it an uptrend. So you have a higher high and higher low sequence, which is a clear sign of a trend, which is long, which is bullish. It's an hourly chart in this context. And so when I say accumulation area, what I want to do here in this context is I want to see the market see a sequence of higher highs and higher lows, and once it pulls in and stabilizes here and shows clear signs of stabilization and turning up again in the overall trend direction and advantage which I spotted, then I say, well, you know what, this is the area when I now see the breakout happening out of my open range breakout approach here on the upside. I traded more aggressively because I think now I have the momentum on my side and buyers will likely step in and push the market aggressively higher up to the recent highs. If I see that the market is trading here in a sequence of higher highs and higher lows, and we're trading somewhere here, so very extended already on the upside, and I'm now seeing a long a signal being generated, well, I start to become more careful. And I should say, well, you know what? I'm not really convinced whether I should trade this very aggressively. I'm not saying that the market can continue to move higher, but at least I'm taking some risk off here. And if I'm, let's say, risking usually 1% of my equity, I'm only risking, let's say, 0.5% to pay the price, let's say, for an unfavorable risk reward on the upside. Remember, this is especially true for long side then, or also for the short side, doesn't really matter. We keep the trade until the evening, until the market closes for the day. So it could easily be that we continue to trade higher and there's a strong breakout, let's say today, okay? We see, in case then we turn the things around here and then we say, okay, we trade the short side now. We see the market really trading lower, and then there's this reversal taking place given the Fed's announcement and market shoots higher. And since we are here looking at a make or break setup, so we are stopped out or we take out the trade in the profit zone, in fact, well, then probably things could turn sour in the second half of the trading day, which means, especially if we are now extended on the downside, we don't want to trade as aggressively on the short side as we used to trade it if we were trading in the so-called accumulation area. So this is the first way to let you trading profit from this from a discretionary perspective. Another is here, for example, as you can see here, use the strategy knowledge as a profitable fundament, first of all, and fine tune it with your personal preferences. Personal preferences here is also something which is interesting because there's also some discretionary touch coming into place. For example, you could say, if I'm, or I spotted, for example, from my end, I spotted that a breakout is likely to be successful and sustainable if there's elevated R vol in this key. So if the relative volume you see during usually, let's say, the last month or so, during the time frame once the breakout is about to happen here, is elevated, because this shows that market participants are getting interesting. And if the breakout then happens, then you will say, okay, this is likely to last because now there's probably institutional flow coming in, pushing the price in direction of the breakout. Or, well, coming out of the market, depending on whether it's on long or the short side. So this is the first thing. So you could bring this in as a personal preference, looking at the volume, for example. You could also say, I want to see increased volatility. At least I want to see the market moving, let's say, 0.2% and have a range, a trading range of 0.2% minimum, because everything below that, and this is especially true once you have shortened trading hours, once you have something like Thanksgiving or Christmas now around the corner, and so on and so forth. What you could see sometimes is that under these low volatility environments, you see a drift, but not a true breakout happening, a drift out of the range, and then the market just rolling back over into the range, or coming back into the range if it's a breakout on the downside. And this is something you could at least reduce, this noise, let's say, you could reduce this if you say, I want to see volatility to be or to be elevated, and I want to see a trading range width here, or open range width, which is at least 0.2% of the index reading, which means in case of the S&P right now, let's say 4,500 points. So if you have 0.2%, that means what you want to see in this context is that the range is minimum 9 points wide. So if it's not 9 points, well, then you're not taking the breakout because it's likely not to be sustainable, in fact. And then if you use this now and how to use this basic approach, these personal preferences you let flow in and so on and so forth, what you want to know is, or what you want to learn out of this is, it's a fully automated basic strategy. And it works, as you have seen, but it also shows you that you sometimes need to be very patient. What all this is about when trading with this approach, and this is something I do, for example, when working with students, in my case, I give them the strategy and say, hey, trade it. And then I say, well, this is great. And then they trade the strategy, they get losing trades sometimes, certainly. So there's these bad runs. And then they say, well, I don't want to trade the strategy anymore. And I tell them, well, keep on trading the strategy. It's not about performance, but it's about getting to know what a trading routine looks like, how to follow a system, proven system here, and be patient, calm, concentrated, disciplined, and focus on just executing and get reps if you want. So continue to trade over and over again, and see the routine playing out the long run, and build knowledge, market knowledge, see how the market behaves. It's something completely different if you trade really and real time, sitting in front of the screen, seeing the market and you have a position on, than just analyzing the chart and saying, well, it's pointing up or pointing down. There's something completely different, and something you have to understand once you trade the markets. And in addition to that, it's not just the trading approach or the trading itself, but also document your trading. So write down your results. How did you feel? Why did you feel the way? What did you do to prepare? If you performed well, what did you do that you performed well? How did your preparation look like? What do you plan to do better the next day? What did you do right? What did you wrong? I mean, the rules are simple. The rules are clear. If you don't follow the rules, well, you simply made a mistake. It doesn't matter whether it was a losing or a winning trade. It's just like you have to follow the rules. If you don't follow the rules, well, then answer the question, why didn't I follow the rules? Write it down. Try to learn something out of this. And that being said, will help you to, even though it's just a basic approach, and even if you rather sooner or later then decide to say, well, breakout trading or open range breakout trading is not my trading style, it still helps you to see how a routine, and how to not just a routine, but also how to improve your trading in general. So what you do is you have the trading itself. You do, let's say, 20 trades, demo account. You document them. You write down your trading results, you review them, you analyze. So what did I do good? What did I do bad? How did my hit rate look like? Or what was my payoff ratio? How does it compare to the stats I just seen here and the historic numbers? Why was I better? Why was I bad or worse than what I should have expected? How did I execute in relation to, and so on and so forth? And if you did this, then you formulate a plan how to improve next time, what to do better, and then do it over again and continue to do this and get reps that way, and increase your overall experience, and really learn something out of something you do. This is way deeper and way more than what you will get out of just saying, hey, I'm going long here because I think market will go up, or I go short here and take it from there. And then at the end of the day, market went really up and you say, great, see how my account grew, at least for this one trade, but not really gaining an insight out of what you just witnessed here and what you just did. So not really learning something out of this. But this is something which is really focusing here on the process. It's not on the result itself, but it's focusing on the process, in fact. And I want to finish today's presentation here with, again, the setup. So I told you at the beginning, take a screenshot. If you haven't yet taken one, take it down. So it's the definition of the open range. You look at it from 330 to 415. So as of now, for example, you still have time, because we have now 350 German time. So still 25 minutes. Just take the approach, look at the S&P for today, special day. Certainly we have the Fed on tap for today, but still, you have still 25 minutes left. You have a high, low, you have the EMA 10 in this case on a 50-minute time frame. And then in relation, if we have a closing price above, we take a long position. If we break out on the upside out of this range, we trade a short trade. If we break out on the downside out of this trade, we keep the position open till the evening, or especially till Wall Street closes then. If we're not getting stopped out, yeah, we realize where we take the position out, not taking it overnight here, if we're not stopped out before, and that's it, in fact. And then again, the process starts then when you say, okay, I have the trade now. This is the documentation. This is what I learned from today. And you review, you tweak it. You research, what did you do good, where did you have a chance to improve next time, and then you formulate a plan to improve, and then you take it over again today, or respectively tomorrow then, and continue to work through this routine over and over again. Yeah, and that's it for today. So here are the contact details. Again, contact Admirals if you're interested in opening at least a demo account. Admiralmarkets.com. You find further information. You have a chance to reach out via email. Check out the YouTube channel. Again, if you haven't yet, subscribe to it. Leave a thumb up here if you enjoyed the webinar. Leave a comment in the chat box. I'd really appreciate it. And fully regulated broker. That was something we mentioned already at the beginning. So here's the risk disclaimer once again. Take care. I think this is my last webinar for this year, as at least. So if we don't see each other again, Merry Christmas, Happy New Year, and talk to you again then in 2022. Take care. Enjoy yourself. Have a great time. See you. Bye-bye.